income, gain, deduction, and loss are deferred between these corporations until a subsequent event occurs. One of those events might be property acquired in an intercompany transaction is sold to a party outside the group. A corporation leaves the group. Depreciation claimed on property acquired in an intercompany transaction. And then corporations in the affiliated group discontinue filing consolidated returns. So we're going to talk about the matching rule and the acceleration rule. And I think the best way to understand these is by examples. So the matching rule says that a consolidated group must take into account an intercompany item in a manner that produces the same result as if the transaction were between two divisions of a single corporation. So in problem 36, we have P, S1, and S2 corporations that have filed consolidated tax returns for several years. In the current year, year 1, S1 sells land to S2 for $275,000. S1 purchases the land for $120,000 several years ago and has held it for possible expansion. S2 constructs a new plant facility on the land. In year 3, S2 sells the land and the plant facility to a third party for cash, with $400,000 of the sales price attributable to the land. In A, we want to know what's the intercompany item, the corresponding item, and the recomputed corresponding item for this intercompany transaction. If this transaction happened between two divisions in the same corporation, this first transaction where we sold land, we wouldn't have any tax consequence in that. So that's what we're trying to recreate. So part A, the intercompany item is S1's $155,000 1231 gain. Remember, S1 sold the land to S2 for $275,000 and they paid $120,000. So that's a gain of $155,000. However, we want to treat these two corporations as though they are the same company for the purposes of a consolidated tax return. So that's the intercompany item. The corresponding item then is S2's $125,000 gain because they sold the land and a building, but the amount attributable to the sale of the land was $400,000, and the basis that they had in that land was $275,000. So they also have a 1231 gain of $125,000, which occurred in year 3. So we want to recognize both the intercompany item and the corresponding item in the year that this asset is sold to a corporation outside the group. And in this case, it's year 3. So the recomputed corresponding item is $280,000. Section 1231 gain. It would be realized on year 3 land sale if S1 and S2 were two divisions of one corporation. So looking in that first graph, the recomputed corresponding item minus S2's corresponding item in year 1 produces a 0 intercompany result. So in year 1, we don't want to recognize any tax consequences on this transaction because we are treating this as though it all happened within the same corporation. In year 3, we have the recomputed corresponding item, the $280,000 of gain, minus the S2 corresponding item of $125,000, which is what's left is S1's intercompany item taken into account. And the way that this graph is written is a little bit confusing. So if you'll look down here at the bottom box, you can see that in year 3, we take into account all $280,000 of gain, 1231 gain regarding this land. So $155,000 of that happened with S1, $125,000 happened with S2. We take it all into account in our consolidated tax return in year 3 as if we have finally sold this land to a third party because we've sold it to a third party. Next, we have P Corporation owning all of S Corporation's stock. Both corporations use the accrual method of accounting, and they file a consolidated tax return. S provides cleaning services to P. In doing so, S charges P $6,000 for the services, and incurs $5,000 of expenses to provide them. How does this transaction affect the group's consolidated taxable income? So before we get into the answer, just logically, if this all happened within one corporation, we wouldn't have income, right? When we recognize this, we wouldn't be allowed to recognize profit if we cleaned our own business. We wouldn't recognize profit. And so that's what we want to recreate in this intercompany transaction. We do it like this. So it causes a $5,000 reduction in consolidated taxable income. Because P&S file a consolidated tax return, it's an intercompany transaction. So the intercompany item is S's $1,000 profit on cleaning. Remember, they charged $6,000. The expenses are $5,000, so they charged a profit of $1,000. The corresponding item is P's $6,000 cleaning services expense, because when P writes that check, P records that as an expense. So the recomputed corresponding item is the $5,000 of expenses the group incurs when providing the intercompany services. Under the matching rule, the group matches all $1,000 of S's profit with P's $6,000 of expense, so the net effect on the group's consolidated taxable income is $5,000. S's $6,000 revenue and P's $6,000 expense are not eliminated in the tax consolidation process, but they offset each other when computing consolidated taxable income. We also have P&S, and they filed consolidated tax returns on a calendar year basis for several years. Both corporations use the accrual method of accounting. On August 1 of the current year, P loans S $250,000 on a one-year note. S charges interest at a 12% simple rate. S repays the loan plus interest on July 31 of year 2. How does this intercompany transaction affect the group's consolidated taxable income? Again, we pretend like we borrowed money between divisions of the same corporation. If we did that, we would have no tax effect on this interest payment. It would be like taking money from one pocket and putting it into the other. So that's what we want to recreate on our tax return. So P's intercompany items are its interest income in year 1 and year 2. S's corresponding items are its interest expense in year 1 and year 2. And these, of course, equal. So the recomputed corresponding items are 0 in both years because no income or deduction would result from the intercompany loan if P and S were two divisions of a single corporation. Under the matching rule, the group matches P's $12,500 of income with S's $12,500 of expense in year 1 and does the same in year 2. The interest income and interest expense offset one another in determining consolidated taxable income. We also have acceleration rules. These are used when the matching rule doesn't apply and the consolidated group takes into account intercompany items immediately before it first becomes impossible to apply the matching rule. So this usually applies when a corporation leaves the group. So in that first example we did where S1 sold land to S2 and then S2 sold it to a third party, and we were able to recognize all of the gain when that land was sold to a third party. But if S2 was leaving the accelerated group before it sold the land, we would apply the acceleration rules. P Corporation owns all the stock of S1 and S2 corporations. The corporations have filed calendar year consolidated tax returns for several years. On September 15th of the current year, P sells all of S1 stock to Michelle, an unrelated individual. What effect does P's sale of S1 stock have on the P, S1, S2 group's current consolidated taxable income? All right, so now anything that was essentially built up in S1 probably has to be taken into account because S1 is leaving the group. So it could have several effects on the group's current year consolidated taxable income. S1's taxable income or loss for January 1 through the 15th must be included in the consolidated return, and the taxable income or loss after that must be included in its separate tax return. Okay, so that, of course, is the day that all the stock is sold. So we have separate returns. That's the dividing line when S1 leaves the group. 2, any deferred income, gain, deduction, or loss from intercompany transactions involving S1 may need to be included in the current year consolidated taxable income under the acceleration rule. And it likely will. If S1 had any deferred gains, expenses, income, deductions, losses from intercompany transactions, it will likely be included in that last consolidated taxable income before September 16th. 3. The group must determine the amount attributable to S1 of any consolidated net operating loss carryovers, consolidated capital loss carryovers, and consolidated charitable contribution carryovers remaining after calculating current year consolidated taxable income. So we will talk about this in the next slide, but these are the things that, as we know from our previous learning, carry forward, right? So if we can't use our net operating loss or our charitable contribution deduction, we get to carry that forward. So if there's anything in the affiliated group that we've been carrying forward, we want to allocate S1's portion of that item to S1 as they leave the group. And number 4, P's gain or loss on the sale of S1 stock must be taken into account for the current year consolidated taxable income. P's basis in its S1 stock must be adjusted for the preceding 3 items.